Dear students, knowledge seekers, and learners, welcome to lecture 5 of week 2, which is based on role of financial markets in the Indian financial system. Today, we will start first of all by understanding the meaning of financial markets, followed by the need for financial markets. After that, we'll try to understand the types of financial markets, followed by the core functions. We will also try to talk about the price discovery mechanism that prevails in the financial markets. Subsequently, we will try to understand the concept of market efficiency, followed by liquidity and risk management. And finally, we will be appreciating the role of financial markets in Indian economy. Let us begin the journey. At the outset, let us try to understand the meaning of financial markets. Financial markets are platforms where financial assets are traded. As they are platforms, their role is to serve the whole financial assets and transactions. Financial markets, they participate in the whole Indian financial system, and there are different participants. The participants of financial markets include investors, those who are investing and pumping money into the market, the borrowers, those who are lending money from the market, financial institutions, those who are regulating the whole financial markets. There are different financial assets also that are being traded, and these assets include the shares, which are also can be divided into equity shares, preference shares, then the bonds are there, which are the debentures. So on one hand, we have equity instruments or securities, and then we have the debt securities. So both are part of the financial assets. Then money market instruments, the instruments that are used in short-term buying and selling in the financial markets. So all these are different types of assets that are being used. Financial markets enable exchange of financial claims, and they provide a set platform where the financial transactions and activities can be properly performed. Let us now try to understand that what is the need for financial markets in Indian financial system. We all are aware that direct financing is limited, so we do not have lots of avenues where somebody can directly lend to the institution or to the entities, and it is also inefficient because then our sources of finances goes down. So we have limited number of options through which direct financing is possible, and generally if we have lesser option, lesser choices, the cost of borrowing money is more. So that is also one of the issues because of which direct financing is not recommended, and financing through markets is more efficient and symmetrical. Financial markets thus provide a structured mechanism for fund transfer, followed by they also bring together the buyers and sellers of the financial instruments. Not only this, financial markets reduce surge and transaction cost. If suppose we compare financial markets with non-markets where individuals and entities have to search for people who are ready to lend money, it will become too complex and too time taking. The cost of serve sometimes will go beyond the cost of transactions. Thus, financial markets help in reducing the search cost as well as the transaction cost. Financial markets enable continuous and organized flow of funds, thus providing robustness in the Indian financial system. Let us now try to talk about the different types of financial markets. The financial markets can be divided into different types, where the first type is money market, the market within financial market that deals with short-term funds. We will go into the detail of it, but generally the short-term funds means that they are less than for 1 year. The second type of financial market is the capital market, which is the market for long-term funds. Generally, in this case, the funds are taken for more than 1 year. However, these short-term and long-term may also be determined and may vary from one business to another, one sector to another. For example, the short-term period for a huge building may be different than short-term period for a fast-moving consumer goods company. So these technicalities may vary, but this is the general rule which is being expressed upon. Then another classification is the primary market, where new and fresh securities, means new equity shares, new preference shares, new debentures, new securities are being issued, which people buy for the first time, like IPOs, initial public offering. The next type is secondary market, where the existing securities are being sold or being traded. The existing security means that already these securities have been issued and now people are buying and selling that were issued way back. So they are termed as the secondary market. Within the financial market, all these types of markets, they serve a specific financial purpose and they are like organs to the Indian financial system, where each organ has a specific function to perform, where each organ relies on other organs. Thus money market, capital market, primary market and secondary market are not independent from each other, rather interdependent on each other, an integral part of Indian financial system. Let us now try to understand the core functions of financial markets. Financial markets facilitate the transfer of funds. Financial markets also enable the price discovery, which means identifying minimum prices for different financial products in a market. Financial markets also provide liquidity to firms and entities, which means they can support their day-to-day operations without any problem of cash flow. Another important core function of financial market is risk management, which is being supported by the financial markets. All these functions of financial markets ultimately determine the market efficiency, which ultimately becomes a boon for the Indian financial system. Dear students, knowledge seekers and learners, let us now try to identify some of the key issues which is being tackled by the financial markets. The first is price discovery. What is price discovery? Price of financial assets identification is known as price discovery. How prices are determined of the financial assets? It depends on demand of financial assets, supply and market expectation. A common phenomena to understand this is demand of financial services and this is supply of financial services. Now this is the equilibrium point, so generally this prices will prevail over here, okay, but they may also vary and depending on that there may be changes in the price. So this whole process depends on demand and supply of the financial assets. Price discovery reflects the company performance, followed by economic conditions, followed by the investor sentiment. In addition to this, price discovery is very important because prices act as a signals for resource allocation. Let us now try to understand how price discovery works. The first important constraint in working of the price discovery is that buyers bid based on expected returns. Each security, each financial asset has some expected returns. Based on the expectation of the returns, the buyers bid, put up a value in the market for those securities. Then sellers offers based on valuation. Whatever bid has been raised by the buyer, the sellers try to understand it, verify it, and they offer their price. The market interaction between buyers and seller in this scenario leads to a price which is known as equilibrium price, where markets are stable because the outcome of stability is actual buying and selling happening, financial transactions taking place. Now this type of continuous trading, it adjusts prices dynamically, which we have already shown through the movement of demand and supply of the financial assets. Thus, price discovery works in a very fantastic and extraordinary manner, where prices are information driven outcomes instead of just valuation. The second important constraint is market efficiency. A market is efficient when prices fully reflect the available information. If the prices of financial assets in an economy cannot be justified by the available information, that means that there is a price bubble going on in the economy which may burst any time. There are different types of efficiencies that are relevant for financial assets. The weak form, where the financial assets are moving very slowly in terms of return. The semi-strong form, it is giving good returns but there is risk, and a strong form where returns and stability both are matching and the assets are performing very robustly in the Indian financial system. Thus, it would be justified to say that efficient markets reduce the arbitrage, that is the middle agent cost opportunities. Let us now try to talk about the importance of market efficiency. Market efficiency ensures fair pricing of assets. Not only this, they also are very important in improving the investor confidence. Market efficiency also enhances capital allocation, and there is an interesting phenomena where capital allocation should be a reflective indicator of market efficiency. In opposite to that, the inefficient markets always leads to mispricing and instability, that thus creating bottlenecks for the Indian economy. Liquidity function is another important function. Liquidity is appropriate availability of cash flow, as well as it can be stated in the form that it is ease of buying and selling assets. Liquid markets allow quick transactions, which means cash flows. Liquidity markets also reduce the price limitations, and liquidity function also encourages the investor participation. Dear students, knowledge seekers and learners, let us now talk about the risk management role performed by financial markets. Financial markets provide instruments to manage risk, and they manage risk through different methods, and these are diversification of the financial risk as well as hedging instruments such as derivatives and forex. Risk management role also reduces uncertainty in financial decisions, thus bolstering the Indian financial system. Let us now deliberate upon the role of financial markets in capital formation. Financial markets facilitate raising of funds for businesses as well as for government sector. These financial markets also encourage long-term investment that can help in promoting infrastructure in the economy. Capital formation is essential for economic growth, and every country is looking to achieve sustained economic growth, which is not possible without adequate capital formation. Thus, financial markets in India play a vital role in promoting capital formation. Let us now try to discuss the role of financial markets in investment opportunities. Financial markets provide avenues for individuals as well as institutions. They allow individuals to explore the markets, explore financial instruments and products according to their disposable income, and then they can invest in those avenues to get efficient returns. The same applies to institutions that are free to invest in sectors which they want are more productive in nature. Financial markets provide lots of investment opportunities, and they also allow individuals as well as institutions to diversify their investment across different types of assets. The whole process through which investment opportunities are opened up for the people and institutions improves wealth creation potential in the Indian financial system, which makes it more robust and also attractive for the foreign investors. Let us now try to talk about the importance of secondary market. Secondary market provides liquidity to investors. It also enables the price discovery. Secondary market is also very important because it encourages participation in the primary market. And finally, secondary market also strengthens overall financial system, and this is quite interesting because if overall financial system is strengthened, it is a win-win situation for any economy. Let us now try to focus on financial markets in India. Financial markets in India are well developed, but they are evolving. The key segments in financial markets in India include money market, which is short-term funds, capital market, which are long-term funds, and these financial markets further divided into money market and capital market. They are also increasingly becoming more digitalized, and their participation is thus increasing. Financial markets in India, they reflect in contemporary times growing financial maturity in the Indian economy. Let us now try to identify the challenges in financial markets in Indian context. The volatility, which refers to the variation in the returns, that is quite a challenge. The second is information asymmetry. There are rumors, there are misinformation, that is also a kind of challenge. The third challenge for financial market is market manipulation, which happens because of insider trading, because of news which is being misrepresented, etc. The regulatory gaps that exist that can allow entities to misuse the rules and regulations, and thus it is important that a strict and strong oversight and transparency should prevail in Indian financial system for financial markets. Let us now try to explore the relationship between financial markets and economic growth. Financial markets channel savings into productive investments. Before we understand this approach and this relationship, it is also important to understand the different issues related to economic growth, such as why economic growth is important. Economic growth is generally characterized by the growing GDP rate, which is gross domestic product, which stands for total goods and services produced by a domestic economy in one financial year. This is one of the major indicators of economic growth. This is important because it highlights that the economy is growing well and the working cycle is going on. So the question is, why economic growth is important? Economic growth is important because it provides opportunities to the people and it helps to improve the economic indicators of the economy, such as employment, income, per capita income, etc. Now, all these are very important for a country to become competitive, to be able to become a developed country, and to provide regularly more and more opportunities for its citizens. Thus, economic growth is very important. Financial markets, being an integral economic aspect of an economy, thus has some kind of relationship with economic growth. Therefore, we are going to explore that relationship of economic growth with financial markets. Remember, this relationship can be unidirectional or bidirectional. What are these two concepts? If variable x impacts y, but y does not impact x, then this kind of relationship is known as unidirectional. If x impacts y and y also impacts x, then this kind of relationship is known as bidirectional relationship. So we will try to explore these issues in this current. Thus, in the light of these discussions, financial markets fundamentally channel savings into productive investment. Savings are basically the idle funds on which we get, the savers or the depositors get only risk-free rate of return, such as inflation adjustment return, if kept in commercial bank. However, the same money can be put to productive investments or productive uses that can benefit the economy by creating more employment, more output, etc. Thus, financial markets facilitate funding, wherein they convert saving into productive investments, and this funding helps businesses. So, businesses includes all forms of business such as sole proprietorship, partnership, companies, etc. Infrastructure products. Most of the projects of infrastructure are related to development, such as roads, railways, dams, hospitals, schools, etc. All these comes under infrastructure projects. Infrastructure projects are important because they improve not only the social indicators but they also provide avenues for more businesses to come into the country and explore the markets. The third facilitation which is being done by financial markets is funding for government initiatives. There are several government initiatives that are also related to social indicators development, such as poverty eradication, employment opportunities, upskilling of the employees and workers, vocational training for students so that they can join the industrial setup, etc. Government initiatives also required huge funding because they have to train people and they have to provide skills to people so they can come into the mainstream of the business environment. Thus, financial markets provide this kind of funding sources, and that is why these operations of businesses such as sole proprietorship, partnership, companies, development of infrastructure projects, as well as the government initiatives, they enhance and provide contribution to economic growth. Not only this, because the savers' money is being translated into productive investment, the financial markets also encourage entrepreneurship as well as innovation. Entrepreneurship is where we have more control, where we can take risk and come up with new products, and it is integral part where we apply innovation. So entrepreneurship and innovation go hand in hand. However, what is required for entrepreneurship and innovation is capital requirement, funding, wherein the risk is very high, default risk is also very high. And in the initial stages, the investors cannot expect returns as well. Thus, entrepreneurship and innovation can only be promoted through financial markets. In addition to this, it should be noted that entrepreneurship and innovation contribute positively towards economic growth. Financial markets also improve allocation of scarce, means limited financial resources. As we know that in the theory of scarcity, resources are limited and bonds are unlimited. Applying the same popular adage, same popular underlying truth of economics, allocating scarce or limited financial resources is important in order to decide about the work which should come up. Financial markets also help to do the same task. Thus, it would be justified to say that efficient markets in the financial markets contribute directly to economic development as well as economic growth. Let us now try to bridge a gap between financial markets and investors' confidence. Remember that financial markets do not operate just on quantitative factors. Quantitative factors include the volatility in the market, the sensitive index or sensex of a market, the number of documents required, etc. Rather, it is more dependent on the information asymmetry as well as over the investors' confidence on the market. It also includes investors' trust. The whole financial market depends on trust of investors, because if there is no trust, people are going to take back their money from the financial markets. And once people start withdrawing money from financial market, there will be huge consequences and the financial markets will move towards a collapse. Thus, investor confidence is essential for market participation. The investor's confidence in financial market is strengthened by transparency, which includes accountability as well as responsibility. Okay. Also, investor confidence is bolstered and strengthened by fair trading practices, where there is no scope for manipulation. Similarly, investor confidence is strengthened in the financial market by effective regulation. Regulation that is simple yet applicable, and implementation happens in quick time span. Thus, financial markets and investor confidence promote stable markets which further attract long-term investment. Also, it should be noted that confidence, which is investor confidence, encourages broader participation of investors in financial assets, that opening up new avenues for investors as well as an opportunity for the financial markets to tap the untapped resources. Thus, overall, it would be justified to say that with respect to financial markets and investors' confidence, The trust of the investor is a key driver of market expansion. Dear students, knowledge seekers, and learners, let us now try to discuss the impact of technology on financial markets. Technology plays a very important role in financial market. If we see the role of technology in today's financial market, we cannot say that it is a limited role. Rather, we will always reach to a point where we will agree that technology is now part and parcel of financial markets. From using technology to digitally record the securities to trading securities on mobile applications, keeping digital records of the transactions, etc., all use technology and enhance the efficiency of the financial processes. Thus, application of technology has transformed the market operations. Also, there have been key developments with respect to technology which has impacted the financial markets positively, as well as which has opened up the gates of financial markets for unbanked and for people who are earlier not investors in the financial markets. The key developments in terms of technology usage in financial markets includes the use of electronic trading platforms such as Grow, Upstox, Zerodha, etc. All these electronic trading platforms are very simple, user friendly, and a person can register or create an account for free in these mobile applications. And through usage of these mobile applications, then anybody can do trading with some minimum amount. Another key development in terms of financial markets include the online brokerage services. Times have gone when an investor had to visit a broker personally to meet, to discuss, to clarify. Now there are online brokerage services where online meeting can happen, online advice is available, online maintained brokerage will be available, etc. And because of this online availability, the online brokerage services have increased as well as improved the access to financial market of the common people as well. Key development due to technology in financial markets has also been successful in promoting the real-time market information. Market information symmetry is very important for competitive price. If there is in any market information asymmetry, the more information asymmetry, the more less will be competition or competitive prices. The lesser the competitive prices, the more problems for the small investors. Thus, the real-time market information is the minimizing of the time from actual transactions to the information related to that transaction. If a company A has sold some of the financial assets today at 2:15 p.m., then real-time market information means at the same point of time, that is 2:15 p.m., with some differences in seconds, the transaction will be informed to all the stakeholders or parties or even the whole financial market. So this beauty has only been happened because of the application of technology in financial markets. Thus, technology in financial markets improves speed and efficiency of transactions. This speed and efficiency is very important because it increases the trust and confidence of the investors as well as makes things simpler for the investors. In addition to this, technology also expands access to financial markets, which provides an opportunity for all the people, including the small investors. Thus, technology has increased market accessibility as well as participation, which has promoted the financial markets. Let us now try to see the future trends in financial markets. The future trends in financial markets include number one, increased digitalization of trading and investing. Most of the trading, that is buying and selling of securities for one day, means intraday, we call it intraday, that the objective is to buy and sell, so the difference in buying and selling is the profit. So this has changed because of digitalization, and trading has also gone up in terms of volume. Similarly, investing, if we talk about investing, where somebody is buying something but not selling it, which means the objective is long-term investment and long-term sustained returns, value creation. So if that is the objective, digitalization has also promoted that kind of investing behavior. The second future trend to look into is the growth of algorithmic and automated trading. With the use of AI, artificial intelligence, or with the use of artificial intelligence or machine learning techniques, the computer softwares, command-based softwares are also available, which can do investing and inform you about the decisions to be taken in investing. So for that, in artificial intelligence mechanism and machine learning techniques, algorithmic methods have come in, applications have come in that will suggest you and advise you what to buy, what not to buy, depending on your interest and objective. Similarly, automated trading can also happen through investment bots. The bots, which are small softwares or robots that promotes that kind of investment. The third is the greater participation by retail investors. More and more small investors have increased their participation, which has resulted into the increase in the volume which happens due to participation of small investors. Small investors though bring small amount of money with themselves, but because they are so large in numbers, collectively their volume is more, which is very important for financial markets. The fourth future trend to look into is the expansion of sustainable and ESG focused investments. This is very interesting, and one new phenomena. ESG stands for environmental, social, and governance. These ESG, environmental, social and governance, they basically try to analyze investments that are more sustainable for the planet. So environment is those investments that are planet friendly, social is those investments that are people friendly, and governance is those investments that are friendly related to the profit. So all these three types of parameters are used to scrutinize the investment. There is also a concept known as socially responsible investment funds. Under ESG, we have socially responsible investment funds. Now, these are sustainable funds, means these are funds which invest only in those businesses or those sectors that are behaving in a socially responsible manner. For example, if there is a company whose operations include using child labor in their factories, then that investment will not fall under socially responsible investment fund, or in that company this particular specific fund will not invest their money. So the investment criteria is always which is good for people, planet as well as profit which is sustainable. Another important future trend to look into is the enhanced use of data analytics in investment decisions. Investment decisions are day by day becoming logical and more backed by evidences. And for that, data analytics techniques are used in financial market. The application of data analytic tools is very important to take scientific decisions or decisions that are backed by some kind of evidences. Thus, it would be justified to decide and conclude that financial markets continue to evolve with innovation and changing investor needs. This whole evolution and change in paradigm helps to make the financial markets more cohesive, more attractive, as well as more dynamic in nature. Not only these future trends, but future trends also include some kind of impact of geopolitical scenario on the financial market. For example, right now as a conflict between Iran and USA is going on, this conflict is having a substantial impact on oil prices and other type of issues as well. And the oil prices fluctuations are then impacting the financial markets of our country. So thus it is very important to imagine more of such future trends and be prepared for those kind of trends. Let us now try to see some real world example in order to understand the relevance of financial markets. The stock market indices reflect economic expectations. So if the stock market of any country is going up, it means that the investors and the people in general, they have a very strong economic expectation, and that is why it is going up. While on the other hand, if a stock exchange is going down, it reflects that the expectation of the entities and people now are pessimistic. Rising markets are always characterized and indicate investor confidence, while the falling markets indicates and they are a signal for uncertainty or high risk. Thus, financial market acts as a barometer of the economy, which reflects the economic expectation of the people and the entities. Dear students, let us now just try to summarize whatever we have discussed in today's lecture. We have discussed that financial markets facilitate efficient allocation of funds in different sectors. We have also learned and appreciated the point that financial markets enable price discovery and liquidity. In addition to this, we also learned that financial markets improve investment and capital formation in the economy. And finally, we have appreciated the point that financial institutions play a critical role in economic development. Dear students, knowledge seekers and learners, thank you very much for being with me.